All righty. Hello, everyone. Welcome to After the Close. The bell has rung, and a lot of people are saying, like, whoo, glad today is over. But let's talk about what a trader or an investor might consider doing if they don't want to take their money and just stuff it under a mattress, or don't want to take all of it and maybe put it in short-term paper like CDs or T-bills or something like that, because we're going through some, well, there was a sea of red on the charts today. We're going to look at that. So how can we invest in a way that we can protect ourselves? So if you are asking yourself that question, because I've asked myself that question plenty of times, that's going to be our topic of conversation. And today we're going to talk about a strategy called a collar. And you can see that the collar is on both sides of my face. And so this collar strategy involves both buying the stock, and then there is, we're going to sell a covered call on one side and then buy a put for protection on the other side. And we'll go over kind of how that works and then do a couple of example trades. If you aren't following me on X, my handle at Barb Armstrong CS. We also have the pleasure of having Mike Fairborn with us in the chat, who's a friend and a fellow coach. You're going to want to follow Mike. He posts a lot of great content. Mike Fairborn CS. So be there, be square. I can see the crowd is shuffling in, and I love that you guys help bring this class to life by being so participatory in the chat. So hello to Helen and Jay and Riceberg and Brown Buffalo. Like, some of these handles crack me up, and Kevin and Andrew and Wiley and Riceberg and the rest of the gang. Okay, so just know before we get started that everything that we cover in this class for general information purposes only, none of it to be construed as a recommendation. Also know that options carry a high level of risk and aren't suitable for all investors. We are using technical analysis, but we're also looking at what the analysts are saying, what's happening in the markets, earnings, what's happening politically in the world, because there's a lot of talk about, tariffs and everything else that's going on. So we're going to look at all of that today. And just know that we use the Paper Money software application on the Thinkorswim desktop platform. It is a great place to learn. But one of the differences is that short options will never be called out early. If you're not familiar with what that means, don't worry. We'll talk about that in the context of our collar or our protective strategy discussion today. So we're going to have a super quick look at the markets. I know that you guys are already pretty familiar, most of you, with what has been happening this week in the markets. Okay, so and then we're going to go and look at what this collar strategy is, and then place a couple of example trades. Okay, so let us bring up our the S&P. This is the S&P 500. And in this class, we are pretending that we've inherited $1 million. We have $1 million to invest. And over the course of the year, we're going to look at both longer term and shorter term strategies, but we have a lot of the accounts still sitting in cash. And so, we're going to look at, we'll have a quick look at what we already have invested. But we're going to focus on this new strategy. So we can see from this high here that this index, and it hit a new all-time high just, what seemed like the day before yesterday. It was actually on February 19th, and it has pulled back 7%. So as I like to say, Chicken Little is out there running around the yard, saying the sky is falling, the sky is falling. And for many people, it's not been a pleasant experience looking at your accounts the last few days if you had a lot of positions in stock. We're now down into correction territory on the NASDAQ, down 10%. And so, sometimes, people will look at these indexes and say, should I just kind of take my money and go home until things settle down? And that is a choice. Or to invest in, shorter term interest bearing assets. Some people might have part of our portfolio and that. Like, we aren't talking about that as much in this class. What we are talking about is how to invest a portfolio or trade a portfolio in such a way as to protect our positions while growing the account or perhaps generating an income. And we're going to talk about different ways we can do that throughout the year. But, you know, the Dow is down, and this Dow 30 is a, you know, based on the price of the stock. And, you know, this one is down the least. It's down, but it's still down 6% off its recent highs. And all the indexes were down today. And if we come out and we look at, you know, I have the NASDAQ up here, we're seeing a lot of red and a lot of gray, which means it didn't move very much. And if we come out here and change heat map to index watch and we come to the NASDAQ, you can see that, you know, almost 80%, 79 out of 101 stocks were down today on the NASDAQ. And some of them were down a lot, like MongoDB and Marvel were probably two of the hardest hit, you know, down 19.8 and almost 27%. And then if we come to the S&P, you know, and I'm not, you know, trying to put anybody into a state of depression. On the S&P 500, it wasn't quite as bad, like 66% of positions down on the day today. But, you know, and that means 167 were up. So it's not all total gloom and doom. And so if you're saying, well, when we come back out of this, whenever that might be, you know, how do I either continue to invest or protect that which I have? And so one of the things I did, not terribly sophisticated, I will admit, was I came to the S&P and looked at the heat map and said, okay, where have we got some green going on the charts? And, it's kind of interesting. So PCAR was one of them, and we're going to look at that. And then we also had, I looked at AT&T and but then when I came out to our positions, we actually bought AT&T on, I believe, this day. And so we have that in our portfolio. And yes, 2 days ago, it had a big down day and then tried to recover. And then today it's moving back to the upside. But if we come to our portfolio and our stocks that pay a dividend, and of course, one of the differences between a paper money portfolio and a live portfolio is that dividends are really paid in a live portfolio, and they aren't paid in a paper money portfolio. And even though dividends are paid in a live account, there is no guarantee that dividends will continue to be paid. But we do already have a position on AT&T. We have 1,000 shares. And we're up quite nicely. And actually, we were up on that one today as well. And it's interesting because of our dividend stocks, where we were looking for a way to generate income. And you may say, well, how come you have these little chiclets beside 3 positions and not the other 2? And to me, I'm always worried that maybe I had a stop loss and it expired, or I didn't put it on correctly and I put it in as a day order. But if we look at this, when we bought AEP, we bought a protective put. And so this one is down a little bit, but we have a put that guarantees, we bought it at 104.30, that we, until March 21st, we could exit our position and, sell it for 100. And the same thing with Altria. So we spent $29 a contract to buy a protective put, which gave us the right to sell the stock at $52.50. Now, we bought it for $55. It's now trading at $57. So even though this protection has currently cost us $175, for some people, that's well worth the price to be able to sleep at night. So one of the ways we can protect our portfolio is through the use of a protective put. And if we put that put on When we buy the stock, we call it a married put. Okay. I don't know anything about divorced puts, but this, we call a married put when you both buy the stock and the protective put at the same time. Okay. So let's come and bring up, let's start with, some people call it Mickey D's, others will call it McDonald's, but here's the idea. I want to go over this idea of a collar. And what we saw is that we had this period of consolidation with McDonald's. And I'm going to put my technical hat on here for a few minutes. I do teach Getting Started with Technical Analysis on Tuesdays at 2:00 Eastern. So please feel free to join me for that if you aren't already doing so. But what we saw here when we look at this chart is that we had it gap down 2 earnings ago, and this formed. So here was a level of support or a floor, which became a ceiling. And then it came up 3 times and kind of bonked its head on this ceiling. And then it broke through on this earnings. So the one earnings, it went down. Next earnings, it gapped up. And then this ceiling became a floor. So sometimes old resistance will become new support. And that's what we've seen here. And in spite of the fact that, the major indices are all down, year to date, McDonald's is up 7%. So, when we kind of look at this and we say, okay, if I wanted to buy McDonald's, not a takeout meal or the Big Mac meal, but if I wanted to buy the stock, how can I protect myself just in case the whole market decides to go south in a hurry? So one of the things that we could do is what we call a collar. So that means we're going to look at this price and we're going to buy the stock. And then we are going to come out and we are going to sell above it. We are going to sell a covered call. Now, when you sell something, and right now volatility is very high, when we sell a covered call, we get paid for that, don't we? And then what we're going to do is take some of the proceeds from that, and we are going to buy ourselves a put. Now, what does it mean when we buy a put? Well, and when we're buying a put for protection, so this is kind of, and this, when we look at this whole strategy together, we call this a collar. And so what might happen? Well, the stock could go up. Okay. So the stock could go up through our covered call. Let's say, and let's say we sell the 320. So if it goes up past 320, when we sell a covered call, we're agreeing to sell the shares. We're saying, hey, if you want to buy my 100 shares of McDonald's for me at $320, happy to sell it to you. Okay, so we could end up called out. And in that case, like our max, the most we can make is if the stock goes up to 320, we get paid this, we have 310. So we'd make about $10 a share plus whatever we sold the covered call for minus whatever we had to pay for the put. And so we can go through that analysis. So we are putting a cap on our gain. And we could end up having to sell the stock. So that could happen. Now, what else could happen? Well, the stock could go up. And if we wanted, we could sell another one. Now, if it was, say, trading up at 315, maybe instead of selling the 320 the next time, we could sell the same one, or maybe we, come out and sell the 325. Okay. I'm hearing in the chat that you guys have lost me, and I'm hearing that from like 4 people. So don't worry. Okay, we're back. Okay, good. Okay. And then what, like, if we open door number 3, a door we all prefer not to open, what else could happen? Well, it could come down here and below our put strike. And we were looking at maybe this 300 put. So if we sell our put here at 300, well, we'd be down $10 a share, or that's $1,000 because it's 100 shares. And it depends on what the price of the put was that we paid, and what we were paid for the call. Okay, so it's a way of protecting ourselves. And at the end of the day, when the market is really bullish and things are going up, you can take a more simplistic approach, but you have to be ready for stormy weather. You've got to have some tools in the trunk. You've got to have a coat. You got to have a hat. You have to have a shovel in case you get snowed in. And so think of this as a protective pack that you can use if you have a sense that trouble is coming. And, many would argue, and I wouldn't disagree, that perhaps trouble has arrived. But does that mean we just sit out altogether? Well, we could. But maybe we could do something like this. And if McDonald's continues to do okay, and somebody had typed into the chat the other day that, these McDonald's franchises, and McDonald's in a ton of different countries. So let's go out to the Analyze tab. Based in 1940. So it doesn't say here how many countries it's in, but it's in a lot of countries. And so if we look at this, but each franchise, they're built locally, their ingredients are sourced locally, all of their containers and papers that their products are wrapped in, they're all sourced locally. So it might be a little more tariff agnostic or less influenced by tariffs than some might initially think. So I thought that was kind of fascinating. And so let's come out to the trade tab and have a look and say, okay, if I come out to April and I look at buying the 320, so it's trading at 310. If I look at selling a call at 320, I'd be paid somewhere between $4.30 to $4.60 a share. We've got 923 contracts. So there's lots of liquidity on these. And then if I turned around and I said, okay, I want protection at around this 300 level. So I'm being paid $4.30, and then I'm going to turn around and spend $3.55 to $3.75 of it. So how would I put that trade in? Well, we're going to come here to the 320 and we're going to buy covered stock. So this is like a buy right. Another word for that is a buy right covered call. So we're spending $305.99 or something in that neighborhood. And then we're going to make sure that our advanced order says first trigger sequence. And then we're going to come up to this 300 put and buy the put. So we're marrying the put to the purchase of the stock, but because we're also selling the call on top, we call this a collar. So we're covered on both sides. Okay. And we're going to make this a day order. And tomorrow when the market opens, we'll just double check, because sometimes, this price will have gone up and maybe you have to pay 306.20. And so you may have to cancel and replace that order if you want to follow along in your paper money account. Okay. So we are going to hit confirm and send, and we are going to set this up. Okay. So I'm just going to put this, into the regular account, and then we'll create a group called callers. Okay, have we got any questions? So Alonzo is here watching live for the first time. So welcome, glad you're here. Yes, somebody said, I don't care how bad it gets, I'm not eating McDonald's. Yeah, when I drive to my daughter's, there's this one little town where the one thing that's opened at 11 o'clock at night when I'm driving through is a McDonald's. And I can tell you, a strawberry shake on occasion can taste pretty good when it's like between that and gas station fare. Okay, so McDonald's. So that's McDonald's. Okay. Would you feel better if I talked about Hershey? Yeah. That's the chocolate bar company. Well, okay, so we're going to talk about Deere next. Okay. Not a Dear John letter. We're talking about Deere the company. So yeah, you could drive your tractor to your local McDonald's maybe. I don't know if it would fit going through the drive-through, but here's another stock that's been uptrending. It's up 13% year to date. And the last 3 days, as the market's been really pulling back, this stock seems to be doing all right. This black line is the 100-day moving average. And the red line is the 30-day moving average. And so it kind of came down here to a similar type low and seems to be moving back to the upside. Okay. And so if we look at this and say, now there are different things we could do, but today we're talking about this collar strategy. And so, maybe with Deere, we want to come down maybe around this, the low today was 480, 482. It came down to 447. So could we do something maybe around that 450 level? And then up here, maybe something around that 500. Let's see. So we're going to come out to Deere. And again, this traded over 1 million shares. We've got, hundreds of contracts here in open interest. So if we look at this and said, okay, if we wanted to sell that 450-ish, that's a delta of close to 20. That would cost us 745 to 805. Okay. And if we wanted to sell the 500 or say the 510, we're up by a little bit, but we're basically selling the call in order to fund the purchase of the protection. And, if the stock comes down, it will have helped ease the pain a bit by collecting this credit. All right. Okay. So again, how would we do this? We go to our 510 and we're looking to buy covered stock. And then we are going to add this put. Oops, you know what? Why did that happen? Well, because I didn't change the advanced order from single order to first trigger sequence. So we're going to do this again, buy covered stock, and then change this advanced order to first trigger sequence. And then we are going to come and add our put. And so our total cost to get in here is what? It's $473.84. $473.84 plus 805. So we're spending $481.89. And so what's the most we can make? Well, it's about $18 a share. And I'm rounding. But it's about $18 a share, because the most we can make if this stock really goes up is 510, because we'd be called out at 510. And so if we say, okay, if we could make $18 a share divided by that almost 482, 18 divided by 480, actually, it's, 482. That's about a 3.7% return. And then to the downside, we know we can get out at 450. And so we're risking about $30 a share. Okay. And then, this could go sideways. So we know the most we can make, and we know the most we can lose. Okay. And we've got this protection in place for the next 42 days. All right. Are there any questions on this? Would you like to see another example? Somebody's saying, I'm just looking at the chat. Mike is saying, I used to love Mickey D's hot apple pies. Geez, I haven't had one of those in a long time. Okay, and somebody's saying, I see a morning star. So good eye. So we had a big down day. Then we had, our low, and this is kind of a doji type pattern. So big tail. So a morning star pattern is made up of 3 candles. And I just started this little series with short sessions, and we're doing 1 candlestick pattern at a time. So the first one was just posted today. It's actually hammer time. We talked about a hammer candle pattern. So this is called a morning star pattern, and that's considered to be a bullish configuration. So Lawrence, you were right on that. You get a star. Okay. Yes. So another example. Okay, we can do a third one. Let's look at, Hershey. Okay, so what do you see when you look at Hershey? So technically speaking, if I'm playing I Spy with my little eye, a game I play on the daily here as I look at a lot of charts, I'm kind of seeing like this inverted head and shoulders, right? But what I do not see yet, and I think I posted this on X today, I don't see a breakout yet. And so if we wanted to be more aggressive, we could go ahead and place that trade, or we could say, you know what? I know this is up 6.7% year to date, because it's had a really nice run since the last earnings, but I am going to wait. And so with this one, we may just wait. Okay. So that's Hershey. How about we come and look at, I've got a couple of other ideas. So here's Cardinal Health. And health is one of those sectors, if we come and we look at the different sectors in the last 3 months, healthcare is actually one of the strongest sectors in the last 3 months. And if we look at the last month, it's also in the top 3, because it's kind of a more localized thing, right? And so, could this one have potential? And again, up 7 or 8% so far this year. It's been uptrending. So we could look at that. The other one, somebody said Hershey had a morning star pattern also. And you're right. Gee, you guys are quick. I like that. So this, and some will say, well, I'm looking for a morning star pattern. I want to see this pattern at a support level. And so you might say, well, Barb, you obviously just did a lousy job of where you drew your line. Maybe the line should have been here. But I saw it come through here and then come back down again. And others might say, well, we had a support level here and then it broke down, came up and just took a couple of turns. But this idea that this pattern here at a support level, you're right, that does look like a morning star pattern. Yeah. Yeah, and somebody's saying, isn't it true that people turn to chocolate in times of instability? Yes, I guess that could be the case, right? Or you may not want to, you may be cutting spending in other areas, but we can all still afford a chocolate bar. So if you want, we can use this one as our example. And so let's go out and look at Hershey. So it's trading at 180 today, which was a really nice way for them to end the day because, it makes the math easy. And so if we come out, oh, did I not finish this? Let me tee up deer. Okay. So we've got that in the queue. And so if we come out to April and we say, okay, it's trading at 180. If we sold the 185, that's actually at a delta of 40. Maybe we want to sell the 190 instead. So if we sell the 190, that leaves us $10 worth of upside. And then if we come on the other side, to this delta of 20, now we're risking 10 to potentially make 10. Okay. So again, we're buying covered stock, and then we're going to come to single order, first trigger sequence, add the put. And again, what's the most we can make? Well, 177.20 plus 225, so that's 179.45. So let's call it 180. You could make about $20 for your 179 investment. So if you could make $20 divided by the 179.40, that's about an 11% return potentially. Now we could also be down, a similar amount. So we have to take that into account as well. But we have a no matter what exit price, because in buying the put, it gives us the right to sell the stock at 170, right up until expiration. Now, if the stock starts to go up, could we take the put off? We could. Oh, I sold the put. No, I didn't want to sell the put. You're right. I wanted to buy the put. There we go. We're buying the put. Okay, it changes the math a little, but yeah. Okay. So guys, we have done 3 example trades, and kind of what was our, the purpose of us looking at these trades today was just to say, hey, in spite of all the chaos going on in the market and all the uncertainty, there are some areas of relative calm, that don't seem to be as buffeted by all of what is happening around us globally with respect to tariffs and everything. So, can we find these areas of calm? I used to love whitewater canoeing, and I don't know if any of you have ever done that or watched, a river or a set of rapids, but there will be a path where the water's really flowing rapidly and you don't want to hit the rocks, but behind a rock, there will be an eddy or a little bit of calm in the water. And sometimes when you're running a rapid, we call it eddying out, where you just go into this pocket of calm. And so this is our attempt to look for both pockets of calm and look at a way to invest in positions where we're protecting ourselves, even while being in these pockets of perhaps calmer weather. And so when we come to the monitor tab, I know that we have just a few minutes left, but what I want to look at, we have these dividend stocks and those have done well. Our growth stocks are getting hit, and Cisco's really been hit. But I think we bought that one pretty early. Oh, no, we just bought it a week ago. So, this one we must have thought was coming back up and has continued down, but it's still above the 30-day moving average. And so, we're going to just kind of continue along with that one. And because we do have an exit in place, and the other one is Fox. And we were in a profitable position on this one until today. And so let's look at what happened with Fox today. So Fox has been pulling down, but again, it's come down to the 30-day moving average. It's still up 11% on the year. When did we buy it? Good question. So if I come down here, right click, and come down to view trades, we bought it February 14th on Valentine's Day. Oh, look at us being all romantic. An evening with Fox News is not what I would call high romance, just saying, but yeah. There we go. So that's when we bought it. So we're down a smidge, okay, on that one. And then our dividend stocks are by and large, we're down a little bit on AEP, but the rest are looking pretty good. Triple M. So we bought this call on Triple M. It expires March 21st. And we did this as an income generating strategy. So far, it's not worked in our favor. But this call is losing value. And so we bought it for a net gain of, or a net price of 153.60. Well, no, we bought the stock for 153.61 and then sold this call. Let's look at Triple M. Okay, so we bought it on this day with the expectation that it might continue to go up. So it's pulled back a little. But if we're drawing things on the chart, which I want to do, it's still kind of holding this support level. And so some might say, hey, it looks like this pattern, if we're, talking candlesticks, is a Harami pattern at a support level, and that's considered bullish. So some might say, well, maybe we should buy back that call, and if and when it goes up again, we'll sell another one, because we sold it for $3.25. It's now worth 90 cents. We're up $500 on that. And so we could say, well, maybe we want to do that. And so if we wanted to do that, what we do is come in and take this order off. So we'd come up to the monitor tab, our working orders, we'd come to Triple M and say, you know what, we want to cancel this exit. And then that was our stop order. So, tomorrow we could go in and replace that once we sell this call. So we come in, create a closing order to buy back that call, and let's see if we can get filled for 90 cents. So we'll just see what happens. And I will check all of these tomorrow when the market opens. Okay, guys, so that is a wrap for today. we still have like almost 150 people on the call live. So here's what I ask as we wrap things up. If you would please hit the like button, what it does is it helps move this up in the algorithm so that more people can find this content. 2, if you haven't already hit the subscribe button, it's in the bottom right corner. If you would hit that, then it just gives you access to all the archives, and it makes it very easy to find all the content that we are publishing all day long throughout the day and throughout the week. So you'll want to do that. And then make sure that you follow us in the land of X, Mike Fairborn CS and Barb Armstrong CS. I don't believe there is a survey today. Just let me scroll up and have a quick look. But I think that we are in the survey free zone, so you are off the hook on that. I want to thank each and every one of you that whether you're joining live or in the archives, if you have questions and you're watching this in the archives, if you type them in down below, I do look at those on a daily basis. We'll be happy to get back to you, typically within 24 hours, unless it's on a weekend. So guys, thanks to Mike for being so great in the chat and the people behind the scenes for helping bring this webcast to life. Take care, everyone. Have an awesome day. Next up will be trading ETFs on Friday morning with Mr. James Boyd, and I believe it will be Mr. Brent Morris tomorrow. So take care, everyone. Bye for now.